Hi Deepak, welcome and thank you for doing this, discussion and this interview and this session with us. The whole objective of this discussion really is to simplify the RBI policy that the governor announced yesterday, and what is the impact going to be on the accommodative stance that he has taken. And really, when I say impact on yield curve, impact on the bond market and fixed income market from an investor point of view. If you could throw some light on that, please.
They came out with the policy yesterday, and that surprised the market. In fact, bond market and equity market both have been got surprised because market was expecting some hardening or like some normalization from Reserve Bank of India in terms of liquidity or in terms of reverse repo rate, since the macros are in favor of that only. But what happened that RBI put the trump card and came out with accommodative stance and maintained the very clear objective of maintaining supporting the growth for the economy. So that was very positive for the bond market. What we have seen in the last week when the union budget was presented, the bond market reacted very negatively because the government came out with a borrowing numbers of around roughly around 14.95 lakh crores, which is a quite a substantial higher numbers which the market was expecting. So the bond yield went up by around 695, 97 level in the last week after budget. And again, on Monday, the market was closed. So Tuesday, the RBI came out with a cancellation of the auction. And on 10th, when the RBI presented the policy, it was very surprising. It was very accommodative. And they have given a very clear view, very crystal view on the inflation number also. That nothing to worry about the inflation as of now. Inflation is going to remain within the RBI band of 2 to 6%, which is going to be around, going to be slightly hard on hardening part by the end of this financial year, by the end of this March. But going forward, the road is very clear and very crystal with the RBI. They have projected a very smooth inflation numbers, which are going to put a less pressure on the bond yield going forward. So bond market has rejoiced yesterday. The bond yields have corrected by 20 basis point yesterday only after the RBI deliberation, and the bond yield closed at around 670, 72 level. And in fact, the RBI also given the promise to the market that they will maintain the supportive liquidity into the system. So that is very going to be keen for the market going to see, despite all the things are happening globally. The bond yields are going to be very like in the range for this financial year, around 6.5 to around 7% level for this financial year. And going forward, we will see that how the calendar for the next half yearly, like 2023, the calendar will be coming for the borrowing numbers, and accordingly the market will react to that.
So, Deepak, you mentioned about the 10-year GSEC correcting, and where do you see right now? It's already corrected about 25 basis point, if I'm correct. So, where do you see it, going forward, or where do you see it headed for the short term, or the long term? I mean, what is your view on that?
RBI projected inflation number on a very comfortable zone. So
Okay.
what they projected inflation for the next financial year is FY23. We'll talk about the FY23 right now.
Okay.
They talk about the inflation to be around 4.5%. So
Sure.
in the Q1 it will be around like 5%, then again 4.9% in the Q2, Q3 again it will be around 4%, and by Q4 it will be around 4.2%. So on
Yeah.
average they are accounting around 4.5%. So that is going to be a very on a comfort zone for the market. So if that going to stay for the next financial year FY23, the only pressure which the market will face of the borrowing calendar, which the government is announced already 14.95 lakh crore. So that going to put the pressure on the market. That supply side will be the pressure. So what we feel that the yield will be around 720 to 25 levels, or maximum up to 730 or 40 levels we can see in the next financial year. And on the downward side, it's limited to around 6.5%. It won't go below 6.5%. So 6.5 is a cap level for the bond yields right now. And over and above at 7.30 on the upper side, we can see for the 10-year bond yield moving in the next financial year.
Okay. Okay. Okay, thank you for that. And what it seems like that RBI is very comfortable with inflation and is positive on the growth momentum after the slowdown with the pandemic. And it's willing to really wait for the the growth in the economy to come back, right? I mean, that's what we understand. Is that right?
Right, that's true, because they are supporting the growth, and for growth momentum, easy liquidity into the system is required. Low rate of interest are required so that the things can pick up. And what we have seen in the budget, that government is focusing on the expenditure. they want to spend money on the capex. They are focused on the capex, and we have seen that their focus is more on developing the like things on the infrastructures and other part. So that clearly indicates that government is also keen for developing the economy. They want the growth to pick up, and even RBI is supporting them by that. So probably RBI will also support in terms of running smoothly the borrowing calendar, which is quite a big size for the bond market. So what we can see, what we can feel from the RBI outcome yesterday, that RBI is there to support the market, RBI is there to support the government, RBI is there to support the bond industry, bond market. It will not allow the yield to go on a higher side because they want the rate to be on the lower side so that the borrowing will be there, and probably we can see that the growth engine can be continued on a faster space.
Okay, okay. Thank you for that, Deepak. And Deepak, we were having a chat earlier, and you mentioned about how the FIIs have not really participated in the bond market, given that the spreads are fair and pretty good and in our country. So, what is your view, and what is gonna what do you feel will happen once the Indian bonds get listed, in the exchange abroad? So, if you could share some of that with us.
Yeah. If you see currently that the US 10 is around more than 2% trading yesterday after the inflation number released. It was 7.5% higher. On the higher side, the inflation number has came. And
Yeah,
the loud is quite loud higher on the market that Fed will increase the rate because
yeah,
they want to cool up, they have to control the inflation. So
sure.
that is there on the card. Definitely the Fed is going to take some action on that because the inflation numbers are quite high. And the bond yields on the 10-year treasury, US treasury has moved up above 2%. If you see today also that our 10-year is at 6.75 levels. So we're having a substantial spread between the US 10-year and the Indian 10-year bond. It is
Yeah,
almost 475 basis point. And
yeah,
if you see the repo rate is at 4% and the
yeah,
10-year is at 6.75%. So
yeah,
that is quite a huge spread, which is 475 basis point, or roughly around we can say 5% on the repo rate. So that gives a quite a good cushion to the market and even to the authorities also, so that they will be comfortable over there. And even the RBI has also allowed the FIs, they have increased their limit, investment limit in the bond market by 1 lakh crore. So that is over and above to 1.5 lakh crore. So now it will be on from 1st of April, it will be 2.5 lakh crores. So now the FI's money will be coming more to the systems where the borrowing is high and supply will be taken care by giving the more limit to the foreign investors. And apart from that, what we can see that even RBI will also participate in the market. They will do some operation twist. They will do some OMOs also. And even we can feel they can do some private placement with the government directly where the bond supply will be cooled off. And as far as the things are there, like a lot of talks are going on about the global inclusion of the Indian bonds, where we can, as you talk about it, that the things are on cards right now. And probably a lot of working has been done by the government on that part. Probably I think it will take another 6 months to another 9 months time. Probably in the next financial year, we can see that Indian bonds are going to list on the global indices. So that will bring a lot of money to the Indian system, where we can see around roughly around 30 billion, roughly around 30 billion we can expect from the foreign about the Indian bond market. So that will help the economy, that will help the market, that will help the system, and that will keep the rates low for getting the growth momentum. So those all are in card for the Indian markets over there.
so this is good news, but do you believe that the RBI holding up rate tightening and really being decoupled from the developed economies where high inflation usually leads to a rate hike? Uh, could all of this have an impact on USD INR? What's your view on
Again,
that?
see what happened that we have a two important part right now. RBI will be comfortable on the inflation part. Unless an inflation becomes the alarming for the market, alarming for the RBI governor or for the RBI,
Sure.
they will not change the stance. They will not increase the rate.
Okay.
And probably if the oil is at around $92 right now, and if it's going to move beyond 100 or continued over at this rate only, then probably there will be pressure on the inflation numbers where the RBI can think about, and we can see a hike of around 25 to 50 basis point in the next financial year, and that may happen in the after July or after September. It will not happen before that. So probably there is a lot of time is over there, and that would depend upon the condition, that how the crude oil will be moving around and how the things are. But right now, RBI is saying that it's a supply side inflation, it's not a demand pull inflation. So they are not worried about it. So unless and until the demand pull inflation is coming up, so RBI is not worried on that part, and probably they may not change the stance and they may not hike the rate. And as far as the other economies are, global economies are concerned, we have seen that other economies have already raised the rate. Bank of England has raised the rate, and probably US is already on the uh,
Cards.
path of raising the rate. So that is
Sure.
clear over there. But
Yeah.
definitely, what we can see is, as I talked to you about the spread part, that we're having a very huge spread right now. So probably we won't see any outflow from the system. The liquidity will remain, and USD INR won't be affected that much. So that will be likely to remain where we are right now. Here, only hardly we can say 20 to 30 paisa here and there we can see on the movement over there, but not that huge movement of as we have seen in 2014 when the suddenly the rates were hiked by 100 basis point in the evening, and the next day we have seen the rupee dollar has become 78, 79. So that part may not happen because right now in currently we are in a very comfortable position. We are on a very RBI has also squeezed the liquidity, so liquidity is slightly on a kept on the track, and the rates are also on track. So probably the yields, the bond market is also pricing the things what's happening globally. So probably it may not hurt it, and the most of the exposure of the FIs are not that much into the market as we have in 2014 and 13 over there.
Sure.
So that exposure is not there. So that that fear of going money outside from the economy is very limited over there.
Okay. So what I understand is you're saying that in the near term there's likely not to be an impact on the USD INR for now. Yeah. Okay, and so thank you for that. And tell us, I mean, the investors here really want to know all this RBI policy, accommodative stance, inflation, rate hike, rate cut. What, for now, what do the fixed income investors do? All those who are looking at investing in, a secure asset class, which is fixed income bonds, all of that. What should they do for a short term and for a long term? If you could just break it up and tell us so they have something to take away from this discussion.
Yesterday's policy is quite clear that RBI is comfortable with the inflation numbers, but definitely we have not to forego that if the global economies are increasing, the inflation pressure they are feeling it. It's going to come to India also very fast. So probably there is, as of now, we have a time that where we can see the rate increase will happen, but definitely going to happen. Not now, 6 months down the line, we can see the rate hike will be coming up. So our advice to the investors who are looking for the shorter duration that they should stay into the shorter end bond up to a maturity of 2 years where they can park their money, and later on they can take a view accordingly that how the interest rates are behaving. And as far as the longer end investors are concerned, so for them we can recommend them the floating rate bonds because that will hedge against the rising interest rates going forward. So they won't be on they will not be getting any capital loss once the rates are hiking. So probably the bond they are buying like floating rate bonds, RBI floating rate bond or something other floaters are available in the market. So that will be adjusted as per the rate increase in the system. So those are the two recommendations for them right now. They can look around over there.
And these bonds can probably be bought directly in from the market, as well as one can buy it in mutual funds, which are where you have these floating rate funds or these liquid or overnight funds. So,
Correct.
Deepak, tell us, in this experience of 25 years in the debt market and fixed income market that you have, uh, when do you think RBI will be comfortable, and with hiking rates, and usually whether it's hiking or reduction of rates, how soon do banks really pass this benefit on to fixed deposit holders? Because everyone says, okay, rate hike हुआ, अभी तक मेरा interest rate बढ़ा क्यों नहीं? और घटा क्यों नहीं ताकि मेरा लोन का रेट कम नहीं हुआ? So when does this usually happen, Deepak? I mean, what should people expect?
First thing we have to see that, as I repeatedly said in that RBI having a certain band for the inflation that is 2 and 6% on the upper side.
Sure.
If the inflation remains sustainable above 6% for a quite a period of time, like for say 1 quarter or 2 quarters, constantly remain above 6% level, and when your real rate of interest turn negative, then we can expect the rate hike from RBI. They can feel that
Yeah.
inflation numbers are going to hurt the economy, and
Yeah.
they will tighten the grip, and the rate hike will happen. So
Yeah.
probably from here, like as I told you, the 6 months down the line, or uh, more than that, probably the first hike will come after post September or like that, where the RBI can hike very like quarter basis point or something like that on the repo rate, and the
Hmm.
things will happen. So probably what happens that once the rate hike will be there, the banks will take immediately, they won't do it immediately because when the
Okay.
cut happens, when the
Yeah.
RBI cut the rates, Even the
Yeah.
bank won't pass on the rates immediately to the investor, as you said very correctly, because
Yeah.
that system, it will take a time to the system to adjust to that rate of interest what's
Sure.
happening into the system.
Yeah.
And it should be durable. It should be durable. It should not happen that RBI high quarter basis point, and then after 6 months time the inflation fall drastically, then again RBI cutting down. So RBI also don't want to do that. RBI will be taking action which is durable in nature, which is required. So once they feel comfortable that inflation on the higher side is going to affect the demand of the economy, the rate hike will come, and banks normally take around 3 to 6 months to pass on that leverage to the investors into the market or the depositors into the market. It won't happen overnight that suppose RBI hike the rate and tomorrow or in a week's time we will see that banks are passing on that rate to the investors or depositors. It will not happen. Probably it will take 6 months, 6 months, around 3 to 6 months time, where we can see that rates are passed on to the investors over there.
Okay. So, guys, when there's a rate hike, wait. It usually takes about 6 months for anything to really have an impact on you. So, thank you so much, Deepak, for this interesting, simple discussion and breaking down the RBI policy with us. We look forward to some more interactions with you. Thank you so much. Thank you.
My pleasure, and thank you very much.
Thank you. Thank you very
Thank you
much.
very much. Yeah.